a lot of observers, analysts, brokerages, even global outfits have started bringing down growth for 2023, even for India. So they're saying that we'll get 7% plus growth in 2022. But in 23, some are already at 6.3%, 6.4%, and one or two have gone down all the way to 5.5% for 2023. Is that being alarmist, or do you think that might come to pass?
I'm not sure why people have sort of turned pessimistic, or rather somewhat downbeat for growth in 23-24 as far as India is concerned compared to 22-23. I can try and guess why they have done so, partly because they think the post-pandemic catch-up having been over, then there will be more moderate growth given global conditions, weak external demand, etc. But even then, I think there is an underestimation of the fact that India's potential growth is not as low as many of them might be thinking. The reason why they have probably, and this is my guess here, why they have probably lowered India's potential growth, and I happened to attend a World Bank seminar on that 2 weeks ago here in Delhi. They look at the last decade's capital formation, and that was obviously a stagnant capital formation scenario in India because companies were trimming their balance sheet, banks were trimming their balance sheet, and we went through a financial system stress. Now, if you take that into consideration and extrapolate on that basis, then potential GDP growth would appear lower. But I actually would argue that on the contrary, because we went through a balance sheet repair phase in the financial sector, both banking and non-banking, and in the corporate sector, once the current uncertainties regarding the pandemic, regarding the conflict in Europe, etc., once they fade slowly over time, I would argue the opposite, that India may be poised to kind of repeat, if not exactly in the same magnitude as we did between 2003 and 2008, India might be poised to repeat some sort of a capital expenditure and credit boom as we experienced in the first decade of the new millennium. Therefore, I am at a loss to understand the pessimism of India's medium-term growth starting from 2023.
Let me bring you back to inflation in India, where there are clear signs of peaking in many parts of the commodity universe. But Indian core CPI, core inflation is still running at 6%, even if you look at the month of June. Is there an element of stickiness that you see or you fear in Indian inflation? Or because what one worries about is whether inflation expectations are getting entrenched after a few months of running very high. Where do you stand on that?
No, I mean, look, forget about this cycle. You could have asked a question about India's inflation stickiness at any point in time in the last 40 years or 50 years. And in my opinion, that stickiness comes from the fact that business compliance cost, our logistics efficiencies still need to be addressed. They are being addressed with respect to the introduction of GST and the physical infrastructure improvements, etc. But it will take some time for them to again be visible in terms of data. So there is a certain stickiness, and also it could be due to the fact that the capacities in India in several sectors are very small. I mean, the Indian industry and farm sector both are fragmented. I understand that we don't need behemoths, but we do need a vibrant Mittelstand, as they say in Germany. So we have extremely fragmented, inefficient spread of capacity both in the farm sector and in the factories. So these are all the reasons for the stickiness that you pointed out. But on the cyclical side, definitely the fact that we are concerned about a 7% inflation, when the inflation rate even in Germany is close to 8 or 8.5%, in the US it is 9%, and in some other European countries it has even crossed double digits, etc., and not to mention the UK, etc. That to me gives me comfort that we are becoming intolerant of inflation, and that inflation intolerance will naturally feed into slower and more stable inflation expectations down the road. Our inflation expectations are not out of control as they were in the early part of the millennium between 2009 and 14. So in that sense, I would say India's inflation, while definitely it is above the target of 2 to 6% range, I think I think it has peaked, and a combination of measures, both fiscal and monetary, have definitely played their part in stabilizing expectations.
We spoke about exports being hit by a global slowdown earlier, Anantha. I want your thoughts on what it could be doing to India's current account deficit, which has started growing again. And while we are nowhere close to the taper tantrum period situation of 2013, what it could do to the Indian currency. I know your thoughts about the rupee is not the only currency which is weakened against the dollar, and that point is taken, and we agree on that. But what level of dislocation do you see on the current account deficit and on the currency front in the months ahead?
No, I think if you had asked me this question 1 month ago, I would have been more worried. But as we discussed earlier in the conversation, with the decline in the commodity prices, oil, industrial metals, food, etc., I'm much more sanguine about the current account situation than I would have been one month earlier. Yes, of course, there is going to be a slowdown in export growth because last year was a catch-up year and we did very well, both with manufacturing. But by the way, you must have noticed that Infosys actually upped its revenue guidance. So the services sector, IT sector exports are doing well, and therefore whatever we might lose in terms of the momentum, if not the growth rate will still be positive on manufacturing exports or merchandise exports in general, but the growth rate may be lower than what we saw in 21-22. So in that sense, there is a possibility that the overall export growth, including services, may not be as badly affected as we think because of external slowdown. But on the demand side, yes, we know the oil import bill, fertilizer import bill, etc., are all contributing to the potential rise in current account deficit to the tune of 2.8 to 3% of GDP, somewhere in the vicinity of $105 billion. And because of the monetary tightening, which usually is accompanied by flight to dollar and risk aversion on the part of portfolio investors, etc., there is concern about financing the current account deficit. But then that is the reason why, as RBI governor put it so well, that's the reason why you buy an umbrella when there is going to be a rain. So we have the $580 billion of reserves, and even if, and we have liberalized some interest rates calculations for non-resident Indian deposits and debt flows, and the government has raised the import duty on gold, etc. So on balance, I would argue, even though it is a challenging situation, and that is where the incremental developments of the last 4 weeks is actually in India's favor. So I'm more comfortable than I would have been a few weeks earlier about India's ability to handle the current account deficit, because bulk of its trade receivables or trade outstandings will be rolled over at a slightly higher interest rate. It is not the government of India that has got outstandings. It is the private sector, and India risk has not been perceived to be worse than what it was. If anything, India's risk has improved, and the Fitch improved the outlook for India's credit rating from negative to stable. So you put all these things together, I think while it is a challenge, I don't think it's an insurmountable challenge for India's monetary policy authorities or the fiscal authorities to handle the financing of the current account deficit this year or next year.